Hi, Robert Maltbie with Maltbie's Minute on the Market. At the office away from the office, where I go to clear the decks, clear the thought process. As we've had a tough market, the gains of the summer have been at this juncture in late September washed away by the correction has happened. Interest rate driven by the market. So I'll cover the macro, some new cyclical, maybe secular factors that have impacted corporate and consumer balance sheets that has made a difference. It'll help us determine possibly where the so-called neutral rate might be, and then looking at the move ahead, what to do, what's attractive. A market so dominated by just 7 stocks, really, truly a flat to bear market within a 7-stock bull market. It has lifted up some others, but that's really the extent of it. Okay, so interest rates have spiked up based on a multitude of factors over the course of the last several weeks to month. About 10 to 12% change, with rates going from about 4 to 4.5%. The equity markets have likewise declined a similar amount. Looking at our indicators, we're registering at some of the worst levels that we've had in history, and that is due. And our indicators have never gone bullish during the whole year, although we've had the market go up, but just not on a firm foundation from our indicators. But we're at about 34 on 100, neutral being 50, so way down. Really, I'll dissect this briefly. Our technicals just gave up, many breaking below near-term support, and a couple big cap indicators breaking, like the Russell and the microcap breaking below 200-day support. The other larger indices, the S&P, the Triple Q, NASDAQ, below 50-day. Looks like they're headed to test the 200-day within, on the S&P 2%, within on the NASDAQ about 10%. Don't know if they'll get there. I don't think so. So the technicals have become negative. They were holding up the market, now negative. The percent of stocks that are below the moving averages, 20, 50, and 200 days, are at bear market levels. Extremely oversold. Put to call ratio very much showing puts dominant and a reversal coming soon. Looking at sentiment indicators, largely sentiment has reversed and become bullish. Namely, the bull-bear pundit indicator ratio is now favorable in that the bears outnumber the bulls by about 1.2 to 1. It's a good indicator. Looking at the valuations, very bifurcated. If you look at the S&P X, the Magnificent Seven, just in and of itself, about 14, 15 times. That's a little cheap on a historical basis. Looking at the S&P with the Magnificent Seven, well, that's still a little bit high at about 18. Looking at the Russell and the microcap Russell and small cap, we're at levels that haven't been seen in quite some time. Very oversold. So looking at the expected earnings ahead, how do we think about where the action is going to be? Well, bifurcation might be the word. The Magnificent Seven, where all the growth is, trading at about 1.4 times on a PE to growth, forward growth basis. The S&P, with the Magnificent Seven included, about 1.6. But what is compelling is the Russell trading below 1 times, and the microcap also trading at similar levels. Looking at a historical relationship on data of the micro small cap to large cap, we're at epic levels here. This has only occurred maybe 3 times. The earnings spread between estimates on the S&P 500 and on the Russell are at just a huge differential, favoring the Russell. This level's only been only registered in 1.7% of the cases, and each time there's been a significant 10-year forward outperformance by the small caps to a significant extent, averaging 16% a year over a decade. 3 times this has occurred. 1973, 1999, and today, and also 2008. So maybe they're actually 2008. Let's throw out 98 that this has occurred. Look back to our indicators. We have finally finishing up there. We have our Fed monetary indicator negative as always. Powell has been the big bad wolf that has chased away Goldilocks again. Didn't hike rates, but pledged not to cut them, and that was unexpected, not priced into the market. Don't know what data he's looking at, because every indicator on a 12-month basis is not down to 2. I don't know what the fixation is with 2. Why not 2.5? 3 is not so bad relative to where we've been. But there, maybe he wants to go down in history glorified as Volcker 2. Not sure. But certainly for him to claim that he's not going to raise rates, he's data-driven, and then say a year from now he can tell that he won't be cutting rates, it's a bit contradictory. Finishing up on that aspect of it, so the monetary indicator is very tight. The aforementioned Fed, the quantitative tightening, the spread, the inverted yield curve, all very tough for investors. Finally, to the positive, to the bright spot, and this is why I believe that there's a big difference now between past recent bear markets. This seems more fear-driven, with the aforementioned indicators going negative, particularly the sentiment and the technicals. If you look at, and this is very encouraging here, unless this gets wiped away, and I kind of doubt it, earnings momentum and earnings results and revisions has turned positive over the last couple quarters, where revision ratios are up, earnings beat ratios are up, and they're continuing to rise at about a 3-to-1 beat ratio, which is historically very positive. Now we're going to see what happens. Maybe that is the lifeline, lifeboat, lifeguard that saves the market. We shall see. But clearly, it is not a time to engage in any Fed fighting. That has been a fool's errand and a very brutal proposition. May as well swim with the sharks to do that. The Fed, looking at what we think the neutral rate should be, this is very important. The structural debt cost has dropped dramatically on the corporate level, about 40%, because corporations are out there at the 7 and 10 year part of the yield curve. They're not impacted by these rate increases on the financing side, and consumers no longer in fixed and adjustable rates. So, and many of them refinanced during COVID at extremely low rates. So the interest rate hikes, the Fed actually has to do way more to get the same impact, about 1.5 times. So looking at that ratio of needing to do that to get the same desired effect of a slowdown, you need to raise that neutral rate. If you're looking at a target of a 2% GDP growth, and you've got inflation that's above that, say 3%, 3.5% on a current basis, you'd need to raise your Fed funds rate about 1.5 points above that normally. That would put us at about that 4% level. But right now we're at 5.5, bucking 6, and that is because of the aforementioned change in the interest rate cost exposure with consumers and with the corporate America. So in a nutshell, don't fight that Fed. Valuations are compelling, particularly in the small cap area. The Magnificent Seven has corrected significantly, about 10% across the board, and again, it's looking attractive on a relative basis. Bifurcation, allocate, nibble in those two areas, small and micro caps, tremendous epic values. This is Robert Maltbie at the beach where it's safe and clear and calm. Thank you very much. Good luck to you. Talk to you next time.